Preparing for a investment research and fund analysis at Morningstar interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at Morningstar? Morningstar appeals to me because its mission is centered on investor outcomes, not just selling financial products. I like that the firm combines independent research, high-quality data, and technology to help clients make better decisions. In a role here, I would bring analytical rigor, curiosity, and clear communication. I'm especially drawn to the culture of transparency around ratings, methodology, and long-term thinking. That aligns with how I want to build my finance career. While answering, focus on Morningstar's investor-first mission, independent research culture, data-driven products, transparency, and how your analytical strengths fit a long-term investment decision-making environment. Question 2. What is the difference between the Morningstar Star Rating and the Morningstar Analyst Rating? The Star Rating is backward-looking and quantitative. It ranks funds within a category based on risk-adjusted historical returns, after fees. The Morningstar Analyst Rating is forward-looking and qualitative, built around pillars such as people, process, parent, performance, and price. I would not treat either as a buy signal alone. I'd use them as starting points, then review portfolio fit, manager skill, costs, and whether the strategy can repeat past success. Make sure to cover backward-looking quantitative ratings versus forward-looking qualitative assessment, risk-adjusted returns, peer categories, analyst pillars, and why neither rating should be used blindly as a standalone recommendation. Question 3. How would you analyze a mutual fund before recommending it? I would start with the fund's mandate and benchmark, because performance only matters relative to the right objective. Then I'd review returns across market cycles, volatility, drawdowns, fees, turnover, and tracking error. I'd also assess the portfolio, sector weights, concentration, factor exposure, and liquidity. Finally, I'd evaluate the manager's process and whether results come from repeatable skill or one-off market conditions. That structure keeps the recommendation disciplined. In your answer, talk about mandate, benchmark, historical performance, risk-adjusted returns, fees, portfolio holdings, manager process, category comparison, and whether outperformance appears repeatable rather than accidental. Question 4. When does active management make sense versus passive investing? Active management can make sense in less efficient markets, capacity-constrained niches, or strategies where skilled managers can exploit information gaps. Passive investing is usually attractive when costs are low, benchmarks are liquid, and active managers struggle to add value after fees. I wouldn't frame one as always better. The right choice depends on objectives, time horizon, tax constraints, fees, and whether the investor has access to genuinely differentiated active talent. Be sure to mention market efficiency, fees, benchmark availability, tax considerations, manager skill, category dispersion, time horizon, and why the decision should depend on investor objectives rather than ideology. Question 5. Why do expense ratios matter so much in fund analysis? Fees reduce the investor's return directly, so even small differences compound heavily over time. For example, on a $100,000 investment earning 7% before fees, a 1% expense ratio versus 0.20% can create a meaningful wealth gap over decades. I'd compare fees within category, not in isolation, because some strategies cost more to run. Still, a manager must deliver enough excess return to overcome that hurdle consistently. While answering, focus on fee drag, compounding, category relative comparison, net investor returns, the hurdle active managers must overcome, and why low cost is a major predictor of investor outcomes. Question 6. How would you explain an economic moat in Morningstar's equity research framework? An economic moat is a sustainable competitive advantage that protects a company's returns on capital. I'd look for sources like switching costs, network effects, cost advantages, intangible assets, or efficient scale. Then I'd test the evidence through margins, market share stability, pricing power, and reinvestment opportunities. A moat matters because it supports forecast durability, which directly affects valuation and the margin of safety for investors. Make sure to cover sustainable competitive advantage, returns on invested capital, moat sources, durability of excess returns, and how moat analysis connects to valuation and long-term investment conviction. Question 7. Pitch me a stock or fund you find attractive.
I'd keep the pitch structured: recommendation, thesis, valuation, risks, and catalysts.
For a stock, I might say I like a high-quality business trading below intrinsic value, because the market is over-penalizing short-term margin pressure. Then I'd quantify upside using a base case valuation and explain what could prove me wrong. At Morningstar, I'd emphasize long-term fundamentals over short-term trading noise. That makes the recommendation both analytical and accountable. In your answer, talk about recommendation, investment thesis, valuation, key risks, catalysts, time horizon, and evidence supporting why the opportunity is mispriced or suitable for investors. Question 8. Walk me through a discounted cash flow valuation. A DCF values a company by discounting expected future free cash flows back to today. I'd forecast revenue, margins, reinvestment needs, taxes, and working capital to estimate cash flows. Then I'd apply a WACC and terminal value, usually using a perpetuity growth or exit multiple approach. The key is not spreadsheet precision, it's whether the assumptions are economically consistent with the company's moat, industry growth, and capital intensity. Be sure to mention free cash flow forecasting, revenue and margin assumptions, working capital, capital expenditure, WACC, terminal value, sensitivity analysis, and economic consistency of assumptions. Question 9. What risk metrics would you review when evaluating a portfolio or fund? I'd use several metrics because no single number captures risk. Standard deviation shows return volatility. Beta measures market sensitivity. Sharpe ratio evaluates return per unit of total risk. And tracking error shows deviations from a benchmark. I'd also look at maximum drawdown and downside capture, because investors feel losses more than variance. The interpretation depends on mandate. A conservative bond fund and small-cap equity fund should not be judged identically. While answering, focus on standard deviation, beta, Sharpe ratio, tracking error, drawdown, downside capture, benchmark relevance, and why risk should be interpreted in context of mandate. Question 10. If you found a data inconsistency in a published fund report, what would you do? I'd first isolate the issue: source file, mapping logic, calculation formula, or downstream reporting. Then I'd compare the output against an independent source and quantify the impact on clients or internal users. If the error is material, I'd escalate quickly, document the root cause, correct the data, and add a control to prevent recurrence. In a research-driven firm, trust in data is part of the product. Make sure to cover root cause analysis, source reconciliation, materiality assessment, escalation, documentation, correction, client impact, and implementing controls to avoid repeat errors. Question 11. How would you handle a client who disagrees with a Morningstar rating or research conclusion? I'd start by understanding the client's concern, not defending the rating mechanically. Then I'd walk through the methodology, assumptions, peer group, and evidence behind the conclusion. If the client identifies a valid data or interpretation issue, I'd acknowledge it and investigate. If the rating still stands, I'd explain it clearly and respectfully. Credibility comes from consistency, transparency, and willingness to challenge our own work internally. In your answer, talk about listening first, explaining methodology, using evidence, staying objective, acknowledging valid concerns, escalating if needed, and maintaining credibility through transparency. Question 12. What market trend are you following right now? And why does it matter for investors? One current theme I discuss is the tension between interest rates, earnings growth, and valuations. Higher rates pressure long-duration assets and raise discount rates, but resilient earnings can offset some of that impact. I'd connect the macro view to asset allocation. Quality balance sheets, pricing power, and reasonable valuations matter more when capital is not free. I'd avoid making a point forecast and focus on scenarios and risks.
Question 13. Tell me about a time you made an analytical mistake. What did you learn?
In a previous project, I realized late that I had relied on an outdated data pull. I owned the mistake, corrected the analysis, and told the team what changed rather than hiding it. The bigger lesson was process discipline. I added source date checks and version control before sending work forward. In finance roles, accuracy matters, but so does how quickly and transparently you respond when something goes wrong. While answering, focus on ownership, transparency, correction, communication, process improvement, quality control, and showing that the lesson changed how you approach future work. Question 14. How do you manage multiple deadlines when accuracy is critical? I'd clarify the priority, deadline, and business impact of each request first. Then I'd break the work into deliverables, identify what must be accurate versus what can be refined later, and communicate timelines early. If capacity is tight, I'd escalate with options rather than surprises. My goal is to protect quality while staying responsive, because rushed analysis that is wrong creates more work downstream later.
Make sure to cover prioritization, stakeholder communication, breaking work into deliverables, protecting analytical quality, early escalation, and avoiding last-minute surprises in deadline-driven finance roles.
Question 15. How is NAV calculated and why is it important for fund investors?
NAV is the per-share value of a fund's net assets.
Mechanically, it equals total assets minus liabilities divided by shares outstanding. For an open-end mutual fund, that NAV is typically calculated daily after market close and used for purchases and redemptions. I pay attention to valuation timing, stale prices, corporate actions, accrued expenses, and cash flows, because small operational errors can affect published performance and investor transactions. In your answer, talk about assets minus liabilities, shares outstanding, daily fund pricing, investor subscriptions and redemptions, valuation accuracy, accrued expenses, corporate actions, and performance reporting. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.